Hey guys, welcome back to Growth Stock Central, and today we're going to be taking a look at Jumia Technologies. So let's start by seeing how the stock's doing today. Right now it's up about 1.6%, so it's not as hyperactive as it's been. We've seen bigger rises in the past week. That being said, about 10 minutes after the market opened, something interesting happened. It actually hit 40 bucks, 40.51 USD to be exact, which is pretty close to its all-time high. But of course, we can't really decide on whether or not we should invest in a stock based on its one-day performance. So let's dig a bit deeper into the history. Jumia was founded in 2012, but it didn't go public until last year. Now let's take a look at how the IPO went. At first, it seems like it went pretty well, right? It went public on April 12th, and by April 26th, it had actually risen by quite a lot. You can see here, it grew by 58.93%. It went all the way up to 40.21 USD. That's where things started to go south though. So, IPO hype dying down isn't exactly anything out of the ordinary. That's how it works, Stocks rise with the IPO and they usually drop right after when people lose interest, especially when speculators cash in on their profit. But what really almost killed Jumia, to be honest, is Citron Research. Now, they're a short-selling firm. You're probably familiar with them for their reports on Tesla. But in early May of last year, shortly after the IPO, about a month after, they released a report saying that Jumia was a fraud, basically. They made accusations against the company, and that really took a big chunk out of the share price. As you can see, from April to May, the share price dropped by 3.7%, which was before the report. But after the report, you can see between May 10 of last year and May 10 of this year, the stock actually dropped by 81%. So if you invested in the peak of the IPO back when it was at 40 bucks and you see it drop down to 4.57 USD, you're going to freak out because at that point there's not much left to recover and you're thinking, is my money gone? Is it ever going to rise back? At that point, there's a lot of uncertainty. I do think a lot of investors cashed in on their money before that when they started to see it drop after the report. Some probably even cashed in, right after the report. But those who were brave enough to stay after that massive drop of 81%, they were rewarded because, as you can see, in the past 6 months, Jumia has been on a rise. In fact, it's up an amazing 600%. So that's a really good return. It's not back at the peak levels after the IPO, but I see it getting there pretty soon. So if those investors actually bought more during the dip, they're probably doing pretty well for themselves right now. Now, the stock is based in Berlin, so even though it caters to an African market, it's actually based in Germany. As you watch my channel, you're going to see a recurring trend. I like e-commerce, there's no getting around it. In fact, 5 of my top 10 stocks are in the e-commerce space. On that note, be sure to subscribe and hit the notification bell so you don't miss the upcoming video on that. Now, back to Jumia. You might have heard people say it's the next Amazon. So is it? In a way, yes, but also no. Amazon is a $1.5 trillion company. You can see that their market cap is currently at 1.55 actually. So you can't really compare the two. In terms of size and also geography, they're worlds apart. But Amazon wasn't always like this. It took several years to become profitable because Jeff Bezos wanted to focus on growth first and foremost. Did the bet pay off? I don't know. Ask him. He's the richest man on earth right now. You can see him looking pretty spry in his suit. I'm sure he's pretty happy with himself and glad he focused on the long term. That being said, Elon Musk has been accumulating wealth pretty quickly recently, so as a Tesla fanboy, I wouldn't be too upset if he took the top spot. That aside, you have to take note and really acknowledge how well Amazon's been doing lately. Last year it made a net income of over $11 billion. That's in 2019 alone. So is Jumia gonna make $11 billion next year? Absolutely not, but it doesn't mean you shouldn't invest, okay? People kick themselves for not investing in Amazon earlier. Then they kick themselves again with Mercado Libre, the biggest e-commerce company in Latin America. So you'll be kicking yourself in 10 years if you don't invest in Jumia right now. You're probably thinking, why go for Jumia with all the uncertainty and volatility when you can go for Alibaba, a much more established company? After all, it's the biggest e-com market in the world with a volume of over $2 trillion. That being said, there's a few reasons why I think you shouldn't invest in Alibaba. Let's take a look at their stock right now. As you can see, they did hit a pretty good high in the 300 range before dropping down. Now, if you're keeping up with the news, that drop was actually due to their Ant-IPO being delayed by the Chinese government. That's not why I think you shouldn't invest in Alibaba. In fact, if you like Alibaba, if you already hold Alibaba, I think now is a good time to add to your holding because this dip is a bit exaggerated. I think it's a temporary issue, so the major drop in their stock price is actually a good opportunity. The reason I think Jumia is a better option for e-commerce than Alibaba is because Alibaba is already a matured large cap company, so it has slower growth. That's just how things work. They get to a certain size and growth just can't sustain itself. So you're thinking, well, how about JD.com? They're also based in China. They have access to the same $2 trillion market, and they're a smaller company with a smaller cap. Can't they grow faster? Well, yeah, they can. And JD.com is actually a pretty decent pick. Now, even though it's decent, it doesn't make it great. I held JD in the past, and I sold it, pretty recently. Didn't take any losses there, but the point is, smaller and faster isn't enough to make it a great pick. There are a lot of small, fast stocks out there. But what really has me iffy on JD.com is the fact that there's been a lot of heat over Chinese stocks recently. I mean, if you think about all the news with the delisting and add to that the trade war between the US and China, I mean, let's be honest, Joe Biden isn't going to be any easier in China. But you can definitely see the impact in the past month on JD.com. It's dropped by 10%. And Alibaba is, victim to the same criticisms because it's also a Chinese stock. So I have nothing against Chinese stocks. I want to be absolutely clear. I have large holdings in NEO, and whether or not its current value is inflated is irrelevant since I'll be holding it for at least 5 to 10 years. So again, there's nothing wrong with investing in Alibaba and JD in our Chinese stocks. But I just think Jumia is a better option right now if you're looking to invest in e-commerce. The question on some people's minds is Jumia overpriced? And that's a pretty decent question. As we said, it's been up 600% in the past 6 months. So you might think it's due for a pullback, and it very well could be. After all, they only have 6.7 million customers as of the end of September 2020, so it's not a huge amount of customers, especially with the rally. You might think it's a bit exaggerated, that the rise isn't justified. But there are a few things you have to consider. I mean, sure, it was cheaper in September and November. So if you want to wait for a dip, that's absolutely fine. I'd advise you actually invest gradually whenever there's a dip, add some to your holding. But as far as the valuation itself goes, I think Jumia is pretty cheap. Not cheap in the traditional sense, but cheap in comparison to some competitors. Competitors like Sea Limited. Now, Sea Limited is based out of Singapore. That has a much smaller population. I mean, there's only 5 million people in Singapore itself. Of course, people in Singapore are generally richer than those who reside in the African continent, so it's not an apples-to-apples comparison. Furthermore, Sea Limited sells to other countries too, not just Singapore. They sell to other countries in Southeast Asia like Thailand, the Philippines, etc. But you can't ignore the fact that there's a big disparity in the market cap. Because Jumia is currently holding a market cap of about $3 billion, while Sea Limited is holding a market cap of $98 billion. So despite being similar companies operating outside the US, there's a big disparity in that market cap. The main thing is you can't ignore the fact that there's over 1.3 billion people in Africa. Furthermore, the continent is developing really quickly in recent years due to foreign investment. When Africa catches up with the rest of the developed world, Jumia will have no shortage of customers with their newfound purchasing power. In fact, MasterCard itself invested in Jumia before the IPO, so that's a testament to its massive potential. Jumia is great. I love Jumia. I'm invested in Jumia. I will keep investing in Jumia. But there are a few things you should consider before you invest in Jumia for yourself. First of all, it can be pretty volatile, especially lately, so risk-averse people should probably steer clear. If you can't handle volatility, if volatility will keep you up at night, if every fluctuation will make you jump out of bed and check your phone, then you should probably invest in more stable stocks like Amazon, Netflix, or even Microsoft since their Azure project is looking really promising lately. I'll be covering that soon. However, if big movements don't scare you, and you're fine with big movements in your stocks, then Jumia is an absolute great option. When it dips, you can either add to your position or you can just ignore it for a week until it rebounds. If you're investing in e-commerce stocks, you're essentially Jeff Bezos minus the astronomical wealth. So play the long game and don't overthink when stocks have a big dip and drop below their average. It'll rebound, unless it's going bankrupt or actually fraudulent, but those are some edge cases that you shouldn't worry about if you're investing in reputable companies. As far as projections go, I see it hitting $100 in the next year. That may seem excessive, but there's a lot of things that has going for it. Some bullish analysts think that Jumia is going to be profitable by next year. That's a bit too generous for my taste. The CEO says it will be profitable by 2022, so that's a better bet. At that point, when it becomes profitable, I could see it matching or even surpassing the current stock price of Sea Limited. Because you have to remember, Sea Limited isn't profitable yet either, despite being 3 years past its IPO. If it hits the same price as Sea Limited, which is at around 200 right now, give or take, That's 400% growth in 2 years. So even just $500 invested right now would be worth $2,500 at that point when it goes profitable, which is, according to the CEO again, 2022. I could see it getting close to the $1,000 mark by the end of the decade as long as it achieves profitability fast enough and grows its customer base efficiently. Obviously, it's quite a long time, so no one can really tell what will happen in a decade. It could surpass my estimate, or they could go absolutely bankrupt for some unforeseen reason. No one knows, but overall, I predict really strong growth over the coming years for Jumia. That's all for now, so leave your thoughts in the comments below. If you enjoyed the video, then hit like because it really helps out the channel. As always, this is Jake and thank you so much for watching.